you have a lot of advertisements that are up and running talking about guaranteed returns. So you see guaranteed returns of more than 15%, 18%. And you see a lot of this type of advertising. And when I get calls being asked, what do you think about this? My natural reaction is, this is a Ponzi scheme. Now, I don't want to be quick to act and say, hey, this is a Ponzi scheme or something is going on here without doing more due diligence, which is very hard to do without understanding the underlying. But that's the natural reaction. It ends up being about educating the investor of why that's so unrealistic. So when you see that type of advertising of guaranteed returns of such high level, what's your natural take on that?
I was initially aghast because one company, obviously I can't name it, was guaranteeing returns of 30%.
30%?
Yes. Then that same company reduced that to 18%, which is still obviously astronomically high compared to what markets usually produce. And much to your point about doing due diligence, obviously, there is only so much you can do without really actually getting invested in it. I did try to piece it together somehow. Was the guarantee really was an undertaking by the company to pay you that return?
No, it's like lending a company money, and I don't have much understanding of the company's fundamentals of its ability to repay me.
Essentially, the way I understood it is the premise is that the company will use your money to generate returns and all that. And if the return were to be below 18%, they will sort of make sure it is 18%.
So don't worry about it. Let us worry about it. And as long as we survive, you're fine kind
Correct.
of
So
mentality.
This is, to your point, this is lending money.
Yeah.
What's the difference?
Yeah. And you can't really assess that health unless the company's health of which I'm lending, unless I really understand the risks they're taking, where are they invested, etc.
Correct.
Hello and welcome to Masters of Wealth. So today we have with us Biswajit for a part 2 episode. In our first part, we discussed many things, including Biswajit's journey. But by the end of the episode, we talked about some common products and common problems that we're finding in this market. And we thought there's so much more to delve into. And that's why we're hosting part 2 of this podcast. So we're going to go more into details on that. Thanks for being our guest for part 2.
Good to be here again.
We left off last time, we were talking about structured notes. And when we talk about structured notes, and I remember you were talking about the element of how a lot of the downside risk is left towards investors. And therefore, essentially, it's almost that they are paying for the protection element side of the market. And I want to delve deep into that. But to delve deep into that, what I thought I would use first is an example of a common type of structured notes. And this is one from a personal story of mine. So I remember this was more than a year ago. I had an individual who gave me a call and sent me a structured note proposal that they had from a financial institution. And this was a basket of 4 banking stocks. And essentially, this is a capital guaranteed note. Capital guaranteed note where most likely outcome is this investor gets 15% per annum return. And if one of the 4 stocks selected goes down beyond 30%, then the investor is left with equity in that one stock. And the way it's positioned is, okay, but if that happens, then you're left with something that's undervalued. And I remember at the time what I was explaining to him was oh, this doesn't seem to fall within your financial objectives in your long term. And why would we allocate to it? So I kind of persuaded this person not to do it. But within these 4 stocks was Credit Suisse. And I did not predict the fact that Credit Suisse is going to go down. Now, thankfully, this person did not invest in it. But should they have, Credit Suisse was bought on pennies of the dollar and they would have lost capital immensely. So I'm trying to give an example of how these products work. Is this the most common type of structured note where it's a basket of stocks and the return is guaranteed? And is this what we're seeing mostly in the market?
Yeah, I would say the bulk of structured products are around reverse convertible kind of structures. Sorry. Which are or worst off or whatever. They have different names depending on who you're talking to. But at the core, they are structured around a certain number of securities, typically 3 or 4, on which, and this is the part that the investor does not see, but really the investor really writes an option on all of these names, right, in different proportions depending on what the payout is. And that payout is then used to generate a return for the customer, right? Now, when somebody writes an option, what does he do? He really gives downside protection to the buyer of the option, right? So in the case of a reverse convertible, he is selling a put, right? And a put is essentially the right given to the buyer to sell at a certain price, right? When does it make sense for the buyer to sell at a price that the option shows? When the market price is lower, because then he can buy in the market at a lower price and sell the option at the higher price, right? So essentially, when you sell a put or invest into a reverse convertible, what you are saying is that you do not expect the price of the securities that are part of the structure to go below the strike price, right? That is alternative one. Alternative two is you are happy should the price go below the strike price to buy it at the strike price. This is the notion on which structured products are sold, right? The problem is what most investors may not realize is that they're essentially giving away protection. So when the market goes down, as happened in the last couple of days, actually, when the markets have corrected by a couple of $1 trillion, that's exactly the time when you don't want to buy the stock at that strike. You want to buy it at much lower price because the price is falling already, right? So you've given away protection, but equally importantly, so suppose you had let's say invested in a reverse convertible that had, as an example, right, Nvidia stock at the beginning of the year, and let's say super microcomputers, and one or two of these, or not Tesla, but let's say even Apple. Let's say these 3 stocks you had written an option on, okay? And you would have at that time been guaranteed a coupon of say 7% or 8% or something like that, right? Now keep in mind that 1 year ago, you could have invested in a deposit and got 5%, right? So you're getting 3% more than what you would have got otherwise, or 4% more than what you would have got otherwise, right? And what you gave away was the right to buy Tesla at a lower price or Nvidia at a lower price than was the price at the time that you went in, right? But what you also gave away, which is so meaningful in this case, is the right to benefit from the improvement in the price of Nvidia in the next 1 year, right? So you actually got 8%, but Nvidia went up by what? 200%? Right? So you actually got the risk of Nvidia on your books on the downside, but you did not benefit from the upside.
And this is because the same investor sold a call option, which means he
would have sold a put. The investor sold a put, so somebody can sell to you, but that would have protected the buyer from a drop in the price. But now that the price has gone up, as a seller of the option, you didn't benefit from it.
So you've only benefited from that.
The difference
from that premium,
correct?
Essentially,
correct. Mm-hmm. So it's actually a fairly dumb way to invest. To ask me, if you really want to invest without taking risk of the downside, you are much better off buying an option. Right, so at least you know that the maximum you will lose is the premium, but if the stock goes up, then you will benefit from the entire upside.
Yeah.
You are better off that way, right? Of course, you have to put up something up front to do that. But that in any case, if you were buying the stock, you would put up more money in any case, right? But you're better off doing that if you believe that the stock's going up, right? Unfortunately, what has happened in this part of the world is somehow a lot of these products, and structured products are one of them, have become some sort of fixed income plus notion in people's mind, that a bond gives me 5% of, let's say, a bond of Apple will give me I don't know, 4.5%. But if I do a reverse convertible on Apple, I can get 7.5%. But the risks are very different.
Yeah.
Right? The likelihood of you are getting back your principal and 4.5% return on Apple bond are multiple times better than the risk that you are taking on investing in the Apple stock.
Yeah.
It's a totally different risk.
Definitely.
Right. But people somehow don't seem to, kind of relate to the idea. And the idea has been aggressively sold by private bankers. And I don't know which comes first, whether the greed of investor comes first or the greed of the banker comes first. I don't know which one. But any which way, it's been sold. Right. And the other so there's a huge market in structured products today. In fact, many external asset managers basically do structured products and a little bit of everything else.
But it's not hard to create.
It's not hard to create. It's now very easy to source, right? But more interestingly, and this is almost giving a trade secret away, is that it is possible to hide charges in a structured product that are completely opaque to the investor, right? So it's entirely possible that the sum total of the premium that the structured product would generate from selling the option is far more than what is getting passed on to the investor, right? So maybe the sum total of the premium is 8%, right? And the investor only gets 4%, and the remaining 4% essentially is sort of
banked,
is kept back by the bank, right? And there are several instances of that happening from time to time. The regulators have cracked down, but it still seems to go on because somehow in people's mind there is this sort of notion that this is like fixed income. And exactly to your point, I mean, we've had so many of these instances where people have got badly wiped out because they've taken on risks that they probably did not understand they were taking on. I mean, we've had these instances in the last 2-3 days when the market corrected sharply. Some good names like Amazon corrected by almost 20%, right, in 2-3 days, right? It would have
Which
been
is normal. Volatility is normal, right? If I were to price real estate on an hour-to-hour or daily basis of actual liquid demand, or any private company, it would experience that kind of volatility because you're not judging it on a quarterly side, on an average smooth quarterly. You're looking at what's the best available buyer right now, which volatility is going to be incurred.
Correct. So, and when, let's say, when Amazon is trading at 180, it is very easy to believe that you would be happy to buy it at 160. But when it trades at 160 or at 150 or at 140, you don't want to buy it at 160.
Yeah. And usually, and although volatility is normal, but sometimes when it goes down to 100, there might be a fundamental reason why it's going down to 100, and that's why we'd usually diversify. But that's the last time you'd want to own that stock. It's after the fact that something has been now common knowledge that this is worth much less than what was assumed is the value.
Correct. And at that point, the whole thesis may have completely, as you rightly said, may have completely changed. So now you don't want to buy it at 160 because something has fundamentally changed, and you probably would be much more comfortable buying it much lower, right? But now you're stuck with it because you sold an option.
And the way I also look at it sometimes is, in the industry, we should always have a long-term view, but what happens is everyone starts having a short-term view. So they say, okay, within the 1 year, what do we predict? But what happens is if you were to take a structure every year for 10 years, and let's say someone has very good predictive powers, let's say they're right 9 of the years. So 9 of the years, they made that 9% per year, 9% per year. But that one bad year, if you get wiped out 80%, it's ruined all the benefit. And now over 10 years, you actually made nothing. But you took the equity risk. So you took the rest of owning the stock, but you didn't get the upside like you rightfully suggested, which would have been 10% per annum, potentially. So yeah, I think this is something very important to shed light on, and really open people's eyes towards that longer term way of investing and the diversification of risk elements to it as well. Yeah, I think our industry has to do much better in doing this.
Yeah, and look, again, I'm not at all suggesting, by the way, that options are a bad idea. There's
hedges, of course.
there are times when you can use options very well. But there is really, in my view, not much benefit in somehow sort of enveloping it in this structure of of risks that are not clear to the investor.
It's not a fixed income instrument.
It's not.
Yeah, that's not its reality.
No.
Correct. But speaking about that, what we also see, what I've seen a lot of over the years, but especially over the past year, is you have a lot of advertisements that are up and running talking about guaranteed returns. So you see guaranteed returns of more 18%? Than 15%, yes. 18%. Yes. And you see a lot of this type of advertising. And when I get calls being asked, what do you think about this? My natural reaction is, this is a Ponzi scheme. Now, I don't want to be quick to act and say, hey, this is a Ponzi scheme or something is going on here without doing more due diligence, which is very hard to do without understanding the underlying. But that's the natural reaction. So it ends up being about educating the investor of why that's so unrealistic. So when you see that type of advertising of guaranteed returns of such high level, what's your natural take on that?
So I was initially aghast because one company, obviously I can't name it, was guaranteeing returns of 30%.
30%?
Yes. Then that same company reduced that to 18%. Which is still obviously astronomically high compared to what markets usually produce. And much to your point about doing due diligence, obviously there is only so much you can do without really actually getting invested in it. But my understanding, I did try to kind of piece it together somehow, was the guarantee really was an undertaking by the company to pay you that return.
No, it's like lending a company money, and I don't have much understanding of the company's fundamentals of its ability to repay me.
And essentially the way I understood it is the premise is that the company will use your money to generate returns and all that. And if the return were to be below 18%, they will sort of make sure it is 18%.
So don't worry about it. Let us worry about it.
Yeah.
As long as we survive, you're fine kind
Correct.
of
so
mentality.
Is, to your point, this is, lending money.
Yeah.
What's the difference?
Yeah. And you can't really assess that health unless the company's health of which I'm lending, unless I really understand what's the risks they're taking, where are they invested, etc.
Correct.
How would we, as an industry, raise awareness of why this is not a good idea? Because investing in such a thing is not a good idea. Right?
Yes.
Let's say we have anyone who comes to you, asks you for that. You would never say, yeah, go for it. Lend an institution money that's giving you anywhere, even above, even if you're talking about more than 10% return on a lending arrangement. And I'm being aggressive by saying more than 10%, right? High quality lending is usually somewhere around 5 to 6%. You can get a bit higher when going into higher yield, but 10% plus something is wrong there. So how do we raise awareness, or how do we explain to individuals the risks there, or why that's not a sound strategy?
This is a very difficult, it's a good question, but it's a very difficult one to answer because, things, first of all, greed is something that people, sort of get motivated by. And if you are not, somebody who questions how this is generated, you're likely to fall prey to it. I mean, you regularly hear of people who lose money because somebody has promised them 3% per month and things like that, and eventually turns out that the guy ups and runs away. Every few months, in the newspaper, somebody else runs away.
And it's not in this region; it's happened globally, right? It's a tale as old as time.
So there is that, right? It also, I guess, helps in this case the company, because you're in a posh office in a very prominent location, you're advertising, you're talking about being regulated by somebody or the other, and all of that breeds a sense of confidence. Really, to me, the only way to deal with this is why you have regulations, right? This is why somebody has to come, and if you are seen to be advertising in a manner that is misleading, this is where the regulator has to come in and say, guys, you've got to make sure that your messaging is accurate.
Yeah.
And that all the risks are communicated.
Definitely. I think when you want investors to have confidence in investing, you need a very strong regulatory environment that leads to that. If the investor wanted to assess the economic viability of something, so what you said is, one, be cynical, which I think is good, right? Yeah. Cynical means seek a second opinion. It means dig deep into it, try to understand it more and more. Is it logical, etc.? But what are checks investors or individuals who want to do wealth management, they want to invest? Because now I feel like what we're doing is we're just telling people, we're perpetuating the problem of people keeping cash. You see, the region is very much over cash, but I think this is the reason, right? We've talked about already some things that go and throw people off, saying, oh, I don't necessarily trust the industry, and therefore they hold too much cash. So instead of that being the messaging, what could that investor do that wants to invest but wants to ask the right questions or be more confident? So what should they be looking out for when being cynical?
The most important thing in any contractual arrangement, such as giving somebody a contract to manage your money, is how is that person generating his income, right? If you are able to understand the incentives that are driving the business, I think half the problem is solved. Right? If you know, for instance, that your advisor or fund manager or whoever it is that manages your money makes his money by charging you a fair amount, and that he's transparent about what he's charging, and that everything and ideally is actually motivated to generate higher returns for you. That is, I think, the most important and the most shall we say, reliable consideration for choosing your advisor, right? To give you an example, a lot of, and you've been in that industry also long enough, so you will relate. A lot of so-called advisors go out to their clients and actually say that you don't have to pay us anything and we will get our money from the bank or whatever it is.
Kindness of hearts.
Yes, yes.
Sarcastic tone, of course.
And you have to wonder, I mean, how is this happening, right? So obviously money is being made, right? Because obviously nobody else, it's a job. People have to, and if there is no transparency about how the money is being made, then you need to find out.
Yeah.
Right, and the easy way for a non-professional to find out if the pricing, etc., is fair, is what some people are wising up to, which is asking 3 people.
Yeah.
Somebody sends you a structure, you talk to 3 people and ask, what is the fair price of this?
Like you mentioned about doctors, right?
Yeah.
So you seek multiple different multiple different experts' opinions.
Correct.
Yeah.
And particularly the one who doesn't have a relationship with you will usually give you the fairest price because he has no axe to grind.
That's how corporates do RFPs, right? Essentially,
exactly.
when you want
to
deal with any vendor, you would usually deal with a minimum of 3 parties to get an indication of what is fair pricing.
Correct.
Makes sense. So if we talk about the most usual profile of a household investor, especially ones in the UAE, there's mostly 2 very common goals. Either someone who is on track towards saving towards financial independence. So they have an income that is higher than their expenses. They're saving and they're on track towards building a pool of assets that they can then rely on for financial independence. That be retirement or whatever that may be. Another pool of household as well is one that they already have a pool of assets already established. They're adding on to it, but they want that assets to already give them partial financial independence or full financial independence. So they want income. So what are some types of allocations towards investments that are sound or reasonable? And we don't have to go into exact percentages, right? Because it will be very unique person to person. But what are some examples of what does a good asset allocation look like for someone with this type of profile over long periods of time?
In general, and this is obviously a broad brush statement given what we're talking about, equities protect purchasing power over long periods of time, right? And maybe even help you grow your purchasing power over long periods of time because of the benefits of compounding and so on, right? Um, the caveat is that it doesn't happen in a straight line, right? So over a long period of time is important because it could have ups and downs and depending. So if you are saving up for the long term, if you are starting off in your career or whatever it is early, and you have sort of a regular source of income that meets your lifestyle needs and so on, and this is money that you can afford to put away for a long period of time, then you are better off investing a larger portion of your investment into equity type returns, because as I said, over a long period of time you would almost certainly be much better off investing in that. I mean, you go back 100 years, that's how it has been. On the other hand, if you are depending on the income from the investment portfolio to support your lifestyle needs, then you need to have a certain amount of predictability to your income. And also, often somebody who's in that stage of life is somewhat advanced in terms of years and all that, and potentially therefore has a lower time window to have a safe line of sight on the growth over the longer term, right? Because if you are, let's say, 60 years old or 70 years old or whatever it is, right, and you now got to fend for the next 15, 20 years or so, that's all the time that you have for your equity market to kind of generate the extra returns, right? If you happen to get into one of these prolonged periods of flat markets or even down markets, then coming out of it may or may not work for you, right? At the same time, you would be deprived of the income stream that you would need to support your lifestyle. So in a general sense, it makes sense as you grow in years and as you start depending more and more from the income from the investment portfolio to make the portfolio more income focused as opposed to growth focused. In the early part of your life, you can be more equity heavy, more alternatives heavy if you wish to, depending on how much you like your sleep. But at least you can have a longer term growth objective in mind. As you grow more in years and in your sort of dependence on the income stream from the investment, you should start moving more and more towards predictability of income, so more fixed income type instruments.
So lending to the company instead of owning the company.
Correct.
So by lending to the company, hey, you take on the volatility of the earnings are up, the earnings are down, because over the long term you have the confidence.
You give me my money back and you give me the returns that you've contracted.
Exactly. Now, when I like that a lot, and in regards to the inflation protection, I feel like a lot of people don't usually see that. But when I own a company that sells coffee, for example, my future stream of income is not in dollars, in euros, or any currency. It's in the sales of coffee. Yeah. So it's in coffee beans, essentially. And that's the importance of equities, and it's so important that we put note on that. Now, something that I've seen a lot is what happens is you have some people who have that conviction, but then they say, okay, well, then I'll buy these 5 companies and I'll lend to this one or this 2 companies. So what do you take on the element of how many different companies, or should I be owning different sectors? Or so what's your take on diversification rather than concentration? Because you do have a lot of investors. I remember someone was saying, I had someone telling me, I have more confidence in Microsoft than the entire market. So what's your take on that view?
So look, I mean, there's enough research out there to show how diversification actually sort of reduces portfolio risk. Now, having said that, if you really truly believe in your ability to analyze companies very well, with good reason, not just believe as in, aspirationally believe, but you have either the track record and or the training and or the experience of doing this to kind of do this in a repeatable fashion, I think there is a case to be made for having a concentrated portfolio. But then you better be watching it very carefully, monitoring everything, making sure. I mean, Berkshire is very concentrated.
Yeah.
right? It's been concentrated forever, for 70 years, right? And it's made crazy amounts of money. But this is a guy who for the last 70 years has been looking at balance sheets day in, day out, 7 days a week.
He's the outlier.
Yeah. If you're willing to do that, be my guest. Right? Most people are not. Most people, in fact, I mean, in my conversation with clients, even as recently as in fact, I sent out a newsletter on the 19th of July saying, guys, market's going to crack. Put in some hedges or do something to kind of reduce your risks. So I have these discussions and people say, no, but technology is going to change the world and AI is going to change the world. I said, yeah, so does internet, right? And we've seen 2000, right? Internet was supposed to change the world, right? The thesis was correct. Internet has changed the world. But have all the people who invested in internet companies in 2000 made money?
No one's on MSN right
That's
now.
the question. The thesis is right, right? Even Microsoft took 15 years to come back to its price in 2000, right? Amazon went from 100 to 6, right? Cisco took 20 years to come back, right? Some companies disappeared. Juniper Networks, Nortel Networks, these were all, stock market darlings, right? They disappeared, right? Then you had, of course, these, infamous ones like pets.com, which basically, never really whatever took off. But that does not invalidate the fact that internet did eventually change the world.
Yeah.
Right? I agree today that AI will change the world. I'm as confident as anybody can be that it will change the world. That does not mean that I would be willing to buy NVIDIA at $1,000. These are two different things.
Yeah, it doesn't give it a limitless company price.
Correct.
It's still bounded by fundamentals.
Correct. What is a fair price to pay? And I'm not suggesting that there is a science to this, but there has to be a certain amount of... So when you say that you're buying something that, is giving you a forward price to earnings of, say, 50, essentially you're saying it will take you 50 years.
At current earnings,
At current earnings to return your money.
And then in the murky future where I don't know what earnings look like in 5 years, it's a world of speculation.
What is the likelihood that it's going to generate this kind of earnings for the next 50 years?
And that's the importance of diversification because it's very hard to predict the future.
Correct.
So in the difficulty of predicting the future, then it's, I want to spread my bet because no one expected in December 2019 of COVID, right?
Yeah.
No one expected a pandemic then.
Correct.
If I invested in hospitality in December 2019, no one could have told me that's a bad idea.
Correct.
Right? Hospitality is a great idea. People were traveling, etc. But that whole point of diversification is to diversify and spread that bet because it's very tough to have a crystal ball.
And look, this is not just for sort of general observations, but even for people within the industry. I mean, IBM notoriously said that, there's an appetite of 50 PCs in the world.
Yeah, that's IBM.
That's IBM.
Yeah, now they're the biggest, thought leaders essentially on this topic. Yeah.
Then you have, the Betamax versus, the DVD battle. Betamax lost, right? Better technology, but it didn't work.
I don't even know what Betamax is anymore.
Correct. And you had, so how many people know that there was an iTouch?
Yeah.
Right? Or an iPod.
Yeah.
Right? These things disappeared, right? Yeah. We only know iPhone.
Yeah.
But there are so many of the other things that just disappeared.
Survival bias, right? As in we only remember the ones that survive.
The success stories and think that this is how it is. It's not.
Yeah.
I mean, EVs.
Yeah.
Right? Now all of a sudden now people are saying maybe hybrid is the idea, not EVs. Yeah. Right? So all of a sudden now Toyota is, the better bet than, let's say, Tesla. Nobody knows.
Yeah.
Right? I'm not suggesting, these are not dumb people. These are people who are in the industry who do this day in, day out. They understand the space and they still get it wrong.
Yeah, you can look at the most intelligent people in history and their ability to predict the future is extremely challenging, of course. And it's even the survival bias of who we remember predicted the future correctly. There was so many smart people who predicted the future, but we remember Michael Burry
Correct.
in 2008 who predicted,
Correct.
The Big Short and predicted the Great Recession.
Correct.
But we don't remember the 50 other people who were brilliant people who did not.
And we do not remember how many times Michael Burry himself got it wrong.
Yeah, of course. Yeah, the famous thing is his investment in water afterwards, and that's a long game.
Yeah.
And there's so many other predictions very intelligent people like himself
get it
make.
wrong.
Yeah, of course. You're not going to get it right all the time.
So no, absolutely. Sure. So you have to look. I think if you the single most important quality, I think that anybody who's spent any time in the market needs to have is humility. You have to know that things can go wrong, right? It could be because your thesis was wrong. It could be because things have happened, right? You try and constantly roll with the punches and make sure that you come out on top, but it changes. NVIDIA itself is a classic story, right? NVIDIA was doing something else altogether less than 3 years ago.
Yeah.
Right?
Definitely.
Completely different thing.
Yeah, they were doing it for gaming platform.
Gaming.
Yeah, they were doing it for gaming.
Exactly.
They were a metaverse play, if anything. Yes, of course. Yeah.
Now he's doing something else altogether. So who has the ability to move, etc.? This is very easy to say with hindsight.
And then
Amazon used to be laughed at for losing $4 on every sale that they made.
Yeah. What is book sales?
Yeah.
Nothing.
Yeah.
It's nothing part of their business.
Yeah.
Industries change, and then when the industry changes, what does that really mean for all the players in that industry?
Correct.
And the indirect players that are associated with that industry?
Who could have thought about, Meta in 2000?
Yeah. Yeah.
Nobody would have thought about Facebook and Instagram and WhatsApp and all this. Nobody knew.
I remember
Even a futurist would not have thought about it.
When Google bought YouTube.
Yeah.
All the news articles, all the smart money was saying, this was an expensive purchase.
Dumb idea.
This is a dumb idea. How are you ever going to monetize this? And look at us now, right? That makes a lot of sense. To move on to like the more personal side of investing or the emotional side of investing. So why do we save, and what is the general purpose of wealth?
This is a very good question, and I think lots of different answers depending on who you talk to, what their situation in life is, and so on. Obviously, the first and the most important one is meeting your needs, whatever your living needs, whether it usually your food, clothing, shelter, schooling, a house, whatever, all those things. For those of us who are lucky enough not to have to think about that, we don't realize how big a part of the world that is actually. Yeah. For whom money actually means the means to survive, right? So I think that's at its core. And if you expand that a little bit, it is security, a sense of being able to deal with unforeseen events, etc. That money can kind of help you cushion. That okay, I have the financial ability to deal with unforeseen problems or whatever it is, long life, etc., health issues, etc. I have the money to do that. Then at some point, it's also a means of keeping score, how well I have done in life, etc. And that's what I think it becomes at some point in time about being keeping score. For some people, it is freedom. The ability to really, which I think once you have got past your sort of needs stage, I think the single most important ability that money gets you is freedom to choose your time the way you want to spend it.
Yeah.
Right? Until then, you have to spend your time earning a living because you got to live. Once you get past that, then it is a choice that you make. And I'm not suggesting anything is bad. You could continue to work because you enjoy working, or you could, bum around if that's what you want to do. I was recently sent a CV of somebody who was an investment banker and has now become a goose farmer.
Why not?
Good for him.
Exactly.
I have a friend who actually was an investment banker who lost somebody else in banking who he was pretty close to, and that triggered something in him. He gave that job up and became a photographer.
Oh, wow.
And has been a photographer ever since. Now this is at least 15 years.
Yeah.
So I think that's what, in the ultimate stage, money should be able to give you, the ability to choose.
Yeah, like that. And if we, and I'll leave this to our last question. So if you look back at your journey and the insights you've shared, what would you say is the most important lesson that you can share with our listeners?
I think I would go back to humility, honestly. I mean, all the hard work, all the research, all the thinking, all the analysis, all the discussions, all of that helps. All of that helps you become better. But you also realize that there is only so much you can control and foresee and plan for and predict and so on. And there are always these curveballs that come at you that really nobody can plan. Like COVID is a great example, actually. I mean, who on earth could have predicted something like this, which would bring the whole economy to a standstill for 2 years, right? And apparently, healthy people, would suddenly pass on, and you wouldn't see them ever again. You wouldn't see your loved ones for 2-3 years. I mean, nobody could have thought about things like this, but they happen.
Yeah. Very good. Well, thank you so much. And thank you for your insights.
Always a pleasure.